Can you really live off dividends alone? Not as a concept, as an actual life. No salary, no commute, just quarterly payments from companies arriving in your account while you get on with things. I spent years believing this was simply where patient investing eventually led. Then I looked at what the mathematics actually required, and the number I found was not the one I was expecting. To replace a $60,000 salary through dividend income at the average broad market yield, you would need approximately $4 million invested. Not $1 million. 4. But the size of that number was not what stopped me cold. What stopped me was discovering that the strategy most people use to build dividend income, the obvious, instinctive, seemingly logical approach, contains a flaw that works against them silently over time. Most people chasing dividends are selecting for exactly the wrong thing without realizing it. By the end of this video, I want you to understand what living off dividends actually requires, and what the strategy most likely to get you there genuinely looks like. I want to tell you where I started with this question. For most of my adult life, dividends felt like the answer to a problem I had never quite been able to name clearly. The problem was this: almost every other form of investment income requires you to do something active at the right moment. You have to sell shares. You have to time a withdrawal. You have to convert growth into spendable cash and hope the market cooperates. Dividends seemed entirely different. Companies pay them simply because you own the shares. The payment arrives whether markets are rising or falling that week. Nothing has to be sold. The capital, in theory, stays whole. I held that picture, clean, self-sustaining, almost frictionless, for a long time before I sat down and ran through what dividend income actually requires in practice. What I found did not make me abandon the idea entirely. Dividends are real and they work. What I found was a much more honest picture of the distance between the version most people carry in their heads and the version the mathematics actually describes. That distance is what this video is about. I spend way too much time turning financial systems into data you can actually see. If what I am sharing today is useful to you, hit subscribe. It helps more than you know. Before any numbers, let me give you the simplest possible picture of what dividend income actually is. Imagine you own several rental properties. Each month, your tenants pay you rent. The properties stay in your possession, untouched, and the income simply arrives. That monthly rent is your dividend income. The properties themselves, still yours, still sitting in your name, are your invested capital. The total rent you collect each month depends entirely on how many properties you own and what they are worth. Own enough, and the rent replaces the salary you used to depend on. Own too few, and the rent barely covers a single bill. That is dividend investing. Income from ownership. Capital that stays whole. The question is not whether the system works. It clearly does. The question is how large the portfolio of properties needs to be before the income becomes genuinely livable, and what kind of properties you need to own to make sure the rent keeps arriving rather than quietly shrinking year after year. Here is where the picture becomes precise. The average dividend yield on a broad stock market portfolio, the annual dividend income expressed as a percentage of total invested value, has historically sat between 1.2 and 1.8% per year. I will use 1.5% as our working figure. Watch this bar chart build from zero. To generate $30,000 per year in dividend income at 1.5%, you need $2 million invested. $50,000 per year, $3,300,000. $75,000 per year, $5 million. I sat with those figures for a long moment. Not with defeat, but with the specific feeling of someone finally seeing a thing they had kept usefully vague for too long. Now, I also noticed something else. There are dividend investments yielding 4, 5, even 7%. Yields that appear to solve the portfolio size problem at a stroke. yields that seem to cut the required capital in half. What I found when I examined those high-yield options closely was not a shortcut. It was something considerably more important to understand before building any dividend strategy at all. The first mechanism is the one that makes dividends real, and the one most people misunderstand when they first encounter them. Think about what actually happens when a company pays a dividend. It takes a portion of its profits and distributes that money directly to shareholders. Cash leaves the company and arrives in your account. Here is the detail that tends to quietly unsettle people the first time they hear it clearly. When a company pays a dividend, its share price typically falls by approximately the same amount on the day the payment is made. A stock priced at $100 that pays a $2 dividend will generally open at approximately $98 the following morning. Watch this flow diagram build on screen. Before the dividend, one share worth $100, dividend unpaid. After the dividend, one share worth approximately $98 and $2 cash in your account. Total, $100. Exactly what you held before. The dividend did not create new value. It converted a portion of the value you already owned into cash. Your total wealth at the moment of payment is essentially unchanged. This is not a reason to avoid dividends. It is the foundation of thinking about them honestly. A dividend is a transfer of form, not a creation of new wealth. Understanding that distinction changes how you evaluate every dividend strategy from this point forward. And it matters enormously when it comes to what I found next. Which brings us to the part of this video I find most important. If you have made it this far, the next part is where the question this video is named after gets a direct answer in real numbers. It is also where I found the piece of information that changed my approach entirely. If you have not yet subscribed to this channel, this would be a genuinely good moment. The second mechanism is the one I now call the dividend yield trap. And stay with me here, because this is where the full picture finally clicks into place. When most people begin building dividend income, they do what feels completely logical. They look for the highest yielding dividend stocks they can find. A stock yielding 6% requires far less capital than one yielding 1.5% to produce the same annual income. The maths look clean, the logic feels airtight. But here is what a closer examination of high-yield stocks consistently reveals. A company with an unusually high dividend yield is very often showing that yield not because it is exceptionally profitable, but because its share price has fallen. Watch this example animate on screen. A company paying $2 per share, when its stock was priced at $40, had a yield of 5%. When the stock fell to $20 and the company kept paying the same $2 dividend, the yield became 10%. The yield doubled because the business declined. The dividend income you receive in cash may be steadily offset or exceeded by the quietly falling value of the shares that are paying it. People who have tracked long-term dividend portfolio performance found this consistently. Portfolios concentrated in the highest available yields have historically trailed those built around dividends that grow steadily over time, often by a wide margin over a decade or more. Chasing yield, as a strategy, has a track record, and the track record is, at minimum, a warning worth reading carefully. Here are the numbers in full. 2 approaches, same starting capital, same time horizon. Approach 1. A portfolio of high-yield dividend stocks averaging 6% yield, starting with $500,000. Annual dividend income at the start, $30,000. Watch this counter as it builds. But now watch the portfolio value line moving beneath it. High-yield portfolios have, as a historical pattern, seen their share prices erode at an average of around 1.5% to 2% per year as companies under financial pressure reduce or eliminate their dividends. After 10 years, This portfolio is worth approximately $416,000. The income has declined alongside it. Approach 2. The same $500,000 placed into dividend-growing stocks. Companies with a consistent record of raising their dividend each year at an initial yield of 2.5%. Annual income at the start, $12,500. Less income initially, but after 10 years of moderate portfolio appreciation, this portfolio is worth approximately $810,000. The dividend income has grown alongside it, now approximately $20,000 per year and rising. If you are sitting with the gap between those two outcomes, that specific feeling of discomfort and recognition is exactly the right response. The space between those two lines on the chart is the yield trap, drawn in real numbers. Here are the 3 things I now understand about dividend income that I did not when I first started asking this question. The first, dividends are a conversion of existing value into cash, not a creation of new wealth. Knowing that clearly means you will think about dividend income the way it actually functions, rather than the way it feels. The second, yield is an incomplete measure of dividend quality. A growing dividend from a growing business has historically produced more reliable long-term income than the highest yield available at any given moment. The number that matters is not only how much the dividend pays today, it is whether the business behind it can sustain and raise that payment over the years ahead. The third, the portfolio required to live off dividends is large, and how you build it matters as much as the decision to build it at all. A strategy concentrated on the highest available yields has a historical track record that most people following that strategy have never examined carefully. Now you have. That changes what is available to you. So, can you really live off dividends alone? I promised at the start of this video to give you a real answer. Here it is without qualification. Yes, in principle and for real. People do structure their financial lives around dividend income. The mechanism is sound, the income is real, but the conditions under which it works are more specific than the general idea suggests. It requires a portfolio large enough that even a modest yield produces a livable income. It requires understanding that dividends convert existing value, they do not manufacture new wealth, and that the portfolio itself can grow or decline depending on the quality of what it holds. And it requires resisting the instinct to reach for the highest available yield, because that instinct, followed consistently, has historically produced a worse long-term outcome than the patient alternative. James does not end this video with a portfolio large enough to retire on today. He ends it with something more immediately useful, a clear, precise picture of what the strategy actually requires, and which version of it the historical data most consistently supports. That picture did not discourage me when I found it. It replaced a comfortable vagueness with something far more valuable, an honest map of the territory I was trying to navigate. The question was never whether dividends work. It was always whether the portfolio you are building is the kind designed to keep working long after the novelty of the first payment has worn off.